If you own silver or gold, the next few minutes could change how you see your savings, because what looks like a quiet market right now is hiding pressure that has only shown up a handful of times in modern financial history, and when it does, it rarely ends calmly. Silver is flashing signals that most people miss, signals that insiders, hedge funds, and seasoned commodity traders watch very closely, and if you ignore them, you may only understand what happened after prices have already moved. Silver has always been the metal that lives in gold's shadow, but history shows it is often silver that moves first and moves faster. To understand why this moment matters, we need to step back and look at what silver actually is in the financial system, not just as a shiny metal or a coin in a drawer, but as a hybrid asset that sits at the crossroads of money and industry. Unlike gold, which is primarily a monetary metal used for reserves, jewelry, and wealth preservation, silver has a split personality. Roughly half of annual silver demand comes from industrial use, including solar panels, electronics, medical applications, electric vehicles, and advanced batteries. The rest comes from investment demand, jewelry, and silverware. This dual role makes silver extremely sensitive to economic stress, inflation, and technological shifts all at the same time. Right now, those forces are colliding. On one side, global debt is at record levels. Governments are running deficits that would have been considered unthinkable a generation ago. Interest rates were pushed up aggressively to fight inflation, but the cost of servicing that debt is now becoming a problem of its own. Historically, when real interest rates, meaning interest rates after inflation, start to roll over or become negative, precious metals tend to respond strongly. Silver, in particular, has a track record of lagging behind gold at first and then rapidly catching up once investors realize what is happening. This is where a key metric comes in, the gold-to-silver ratio. This ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Over the last century, this ratio has averaged roughly between 50 and 60. At moments of extreme financial stress or market distortion, it has spiked much higher. In recent years, it has hovered around historically elevated levels, at times pushing above 80% or even 90%. What does that mean in simple terms? It means silver is historically cheap relative to gold. When this ratio eventually mean reverts, which it has always done in the past, it usually happens not because gold collapses, but because silver surges. Francis Hunt, also known to many as the market sniper, has repeatedly pointed out that silver tends to move in violent, compressed bursts. It does not climb gently like a staircase. It behaves more like a spring being pushed down. The longer it stays suppressed, the more energy builds. Underneath, when the pressure is finally released, price can move rapidly, sometimes doubling or tripling in a relatively short period. This is not hype, it is observable in past cycles, including the late 1970s, the 2010 to 2011 run, and smaller but still powerful rallies in between. Another critical factor right now is supply. Silver mining is not like gold mining, where higher prices quickly incentivize new production. Most silver is produced as a byproduct of mining for other metals like copper, lead, and zinc. That means even if silver prices rise, miners cannot instantly flood the market with new supply unless those other metals are also being mined at higher rates. At the same time, ore grades have been declining for decades, meaning miners must process more rock to get the same amount of metal. This raises costs and limits how quickly supply can respond. Overlay this with industrial demand, especially from solar energy. A single solar panel uses a small amount of silver, but when you multiply that by millions of panels installed each year, the numbers become significant. Governments around the world are pushing green energy transitions, regardless of political cycles. Even modest increases in solar adoption translate into sustained silver demand that does not disappear during economic slowdowns. Unlike investment demand, industrial demand is often price inelastic, meaning manufacturers need the metal regardless of short-term price swings. Now consider the paper market versus the physical market. This is one of the most misunderstood aspects of silver. The price you see quoted on screens is largely determined by futures contracts and derivatives, not by physical bars changing hands. For every ounce of physical silver that exists, there are many multiples of paper claims tied to it. Under normal conditions, this system functions because most participants never ask for delivery. But when confidence wavers and more investors want physical possession, stress appears. Premiums rise, inventories draw down, and disconnects form between paper prices and physical availability. We have seen hints of this in recent years with unusually high premiums on coins and bars, even when spot prices appeared calm. That is a quiet warning sign. It suggests that the quoted price may not fully reflect real-world supply and demand. Francis Hunt often emphasizes that true price discovery happens when physical demand overwhelms paper suppression. When that tipping point arrives, the move is not subtle. Bar silver is also historically sensitive to monetary debasement. When currencies lose purchasing power, people instinctively look for stores of value. Gold usually gets the headlines, but silver's lower unit price makes it more accessible to a broader population. This matters more than most people realize. If even a small percentage of global savers decide they want some silver exposure, the available investment-grade supply can be overwhelmed quickly. There simply is not that much above-ground silver available at current prices. Think of it like a narrow bridge during rush hour. It works fine when traffic is light, but the moment too many cars try to cross at once, everything locks up. Silver's market is that bridge. Small inflows can cause disproportionate price reactions. This is why silver rallies often feel chaotic and emotionally charged. They are driven by urgency and scarcity, not calm portfolio rebalancing. Another layer to this alert involves the broader commodities cycle. Commodities tend to move in long waves, often linked to inflationary periods and infrastructure spending. Many analysts believe we are still in the early to middle stages of a broader commodity upcycle. If that view is correct, silver is not just a monetary hedge, but also a leveraged play on industrial growth and energy transition. That combination is rare and powerful. At the same time, central banks continue to accumulate gold, quietly signaling a lack of faith in the long-term stability of fiat currencies. While central banks do not buy silver directly, their actions influence investor psychology. When people see institutions hedging against currency risk, it reinforces the case for hard assets. Silver benefits indirectly from this shift, especially when gold prices hold firm or rise, creating the conditions for the gold-to-silver ratio to compress. None of this means silver moves straight up tomorrow. Markets rarely reward impatience. What it does mean is that the setup looks increasingly asymmetric. The downside appears limited by production costs and physical demand, while the upside remains open-ended if sentiment shifts. This is why many experienced investors pay attention to silver not when it is exciting and trending, but when it is quiet, frustrating, and seemingly forgotten. So the real question is not whether silver will move, but whether you recognize the signs before it does. History suggests that by the time silver is all over the headlines, the easy part of the move is already behind us. The alert here is about positioning, understanding, and timing. Because moments like this do not announce themselves loudly. They whisper, and those whispers are getting harder to ignore now. Now is the moment to go deeper into what could actually trigger the next major silver move. Because markets do not move on hope or fear alone. They move when pressure finally overwhelms structure, and silver's structure right now is under more strain than most people realize. One of the biggest misunderstandings among everyday investors is believing that price alone tells the full story. In reality, price is often the last thing to react. Before price moves, stress shows up in positioning, inventories, spreads, and behavior, and silver is quietly flashing signals across all of these areas. Start with positioning in the futures market. Large commercial traders, often referred to as bullion banks, have historically held sizable short positions in LVR. They act as liquidity providers, but they also benefit from stable or declining prices. When these entities begin reducing their net short exposure, it often signals that downside potential is becoming limited. At the same time, managed money, hedge funds, and trend followers tend to pile in late. In past cycles, the most explosive silver rallies began when speculative interest was low and commercials were backing away from aggressive short positions. That setup appears to be forming again, where enthusiasm is muted, headlines are focused elsewhere, and yet the structural pressure is building underneath. Another signal comes from inventory data, particularly at major exchanges. When registered silver inventories decline, it means there is less metal readily available to meet delivery demands. Even modest drawdowns can matter because the leverage in the paper market is so extreme. Think of it like a warehouse issuing hundreds of claim tickets for the same stack of boxes. As long as nobody shows up to collect, it works. The moment too many people arrive at once, the illusion breaks. Over recent years, we have seen periods where inventories fall steadily while price does not respond in kind. That divergence is not normal in the long run. It is tension waiting for a release. Premiums in the retail market add another layer of evidence. When the quoted spot price remains flat but the cost to actually buy coins and bars rises, it tells you something important. It means demand is stronger than the paper price suggests. Dealers raise premiums not out of greed, but because their replacement costs are rising or supply is uncertain. This has happened repeatedly in silver, especially during periods of economic stress. The fact that premiums remain elevated even during quieter price action suggests that underlying demand has not gone away. Francis Hunt often describes markets as narratives battling mathematics. The narrative around silver right now is boredom. It is seen as underperforming, frustrating, and overshadowed by tech stocks, cryptocurrencies, or even gold. But the mathematics tell a different story. When you calculate above-ground investment-grade silver relative to global wealth, the numbers are shockingly small. There simply is not enough metal to satisfy widespread interest at current prices. This mismatch between perception and reality is where opportunity often lives. Another catalyst worth examining is currency instability. While inflation rates may appear to be cooling on the surface, the structural drivers of currency debasement remain intact. Massive debt, aging populations, geopolitical fragmentation, and rising military and infrastructure spending all point toward continued pressure on fiat systems. Silver has historically performed well during periods when confidence in paper money erodes, not necessarily during outright collapse, but during the slow realization that purchasing power is being quietly diluted. Look back to the 1970s. Inflation did not rise in a straight line, and silver did not move immediately. There were pauses, pullbacks, and moments when it seemed like the story was over. Then suddenly, silver accelerated dramatically. The move was not driven by speculation alone, but by a broad loss of faith in monetary stability. While today's environment is different in many ways, the underlying dynamic of too much debt and too much currency creation remains strikingly similar. Industrial demand adds another layer of complexity. As electric vehicles become more common, silver usage in electronics, power management systems, and charging infrastructure continues to grow. Medical applications, from antimicrobial coatings to diagnostic tools, consume silver in ways that are rarely recycled. Unlike gold, much of the silver used industrially is gone forever. This creates a slow but persistent drain on available supply. Over time, that matters far more than short-term trading flows. There's also a geopolitical angle that cannot be ignored. Resource nationalism is on the rise. Countries rich in natural resources are increasingly aware of their strategic value. Mining jurisdictions are becoming more challenging, with higher taxes, stricter regulations, and political uncertainty. This raises the risk premium for future supply. Markets often underestimate these factors until disruptions actually occur. By then, prices have usually already adjusted. For gold holders, silver's behavior matters more than many realize. Historically, silver tends to outperform gold during the later stages of precious metals bull markets. Gold moves first as a safe haven, then silver follows with greater volatility. This is why seasoned investors watch the gold-to-silver ratio so closely. When that ratio starts to compress rapidly, it is often a sign that the broader move is entering a more dynamic phase. We are not necessarily there yet, but the conditions that precede that shift are increasingly visible. It is also important to address risk honestly. Silver is volatile. It can move against you sharply in the short term. That volatility is the price of admission for its upside potential. Understanding this helps investors size positions appropriately and avoid emotional decision-making. Silver is not about chasing momentum at the top. It is about recognizing value before momentum appears. Ask yourself a simple question. If silver were to double from here, would the reasons be obvious in hindsight? History suggests they would. People would point to industrial demand, monetary stress, supply constraints, and geopolitical risk, all of which are visible today. The difference between those who benefit and those who watch from the sidelines often comes down to timing and conviction, not access to secret information. This is why the alert matters. Not because silver is guaranteed to explode tomorrow, but because the balance of probabilities is shifting. When markets are priced for complacency but surrounded by unresolved stress, the potential for surprise grows. Silver thrives on surprise. It thrives when expectations are low and reality intrudes forcefully. As this pressure continues to build, the next phase will not begin with a gentle announcement. It will likely start with subtle changes, a ratio breaking down, a spread widening, inventories tightening just a bit more, and then suddenly, attention returns. By the time it feels obvious, positioning will already be crowded. Understanding this cycle now gives you the context to interpret what comes next, because this is where understanding turns into preparation, and preparation is what separates those who react emotionally from those who respond strategically when volatility finally arrives. Silver does not reward panic buying or headline chasing. It rewards patience, aligned with insight, and this is where many people struggle. They want certainty in a market that only ever offers probability. But silver's story has never been about guarantees. It has been about asymmetry, about a small market carrying an outsized burden of monetary, industrial, and psychological pressure until it can no longer contain it. One of the most important ideas Francis Hunt often emphasizes is time compression. Markets can move sideways for months or even years, creating frustration and disbelief, and then resolve in a matter of weeks. This happens because the underlying forces are building quietly while price appears stagnant. Think of it like water behind a dam. The surface looks calm, but the pressure underneath is immense. When the structure gives way, it does not do so politely. Silver's historical charts are full of these moments where years of inactivity are erased by explosive rallies that leave latecomers shocked. Another element that deserves attention is correlation breakdown. In stressed environments, assets that normally move together can suddenly decouple. Stocks may fall while bonds fail to protect, or currencies may weaken together instead of offsetting each other. In these moments, tangible assets often reassert their role. Silver's correlation with risk assets can shift rapidly, moving from behaving like an industrial metal to behaving like money. This dual nature is confusing for algorithms and models built on stable relationships, which is another reason why silver moves can feel disorderly and abrupt. Then there is the psychological component. Silver is infamous for shaking people out just before major moves. Sharp drops, false breakouts, and sudden reversals are part of its character. These moves are not random, they exploit human behavior. When confidence is low and narratives are negative, selling pressure becomes easier to manufacture. This is often when strong hands accumulate. Understanding this pattern helps explain why silver often feels hardest to own right before it performs best. For those who already own gold, silver acts like a pressure valve. Gold tends to attract institutional and central bank interest, while silver captures the energy of private investors and industry. When confidence in the financial system weakens, gold stabilizes first. When that lack of confidence spreads, silver amplifies the move. This is why the two metals are best understood together rather than in isolation. Ignoring silver when you understand gold is like watching the weather but ignoring the wind. Another overlooked factor is recycling. While silver is recyclable, much of it is not economically recovered, especially from small electronics and industrial components. As prices rise, recycling does increase, but it rarely offsets new demand entirely. This creates a lag effect where higher prices are needed for longer periods to incentivize meaningful secondary supply. During that lag, price must do the work of balancing the market, and price tends to overshoot. There is also a generational aspect to consider. Younger investors have grown up in a digital world with cryptocurrencies, apps, and instant access to markets. Many have never experienced a prolonged period of currency weakness or inflation that meaningfully erodes purchasing power. As that experience begins to set in, perceptions change. Hard assets that once felt old-fashioned start to look practical. Silver's affordability compared to gold makes it an entry point for this shift in mindset. Even small allocations, multiplied across millions of people, can strain a market this size, from a technical perspective. Long-term charts show silver spending extended periods building bases. These bases are not exciting, but they are necessary. They represent transfer of ownership from weak hands to strong hands. When resistance levels that have capped price for years finally break, the move is rarely contained to a few percentage points. It often triggers algorithmic buying, momentum strategies, and media attention in quick succession. This cascade effect is why silver rallies often feel sudden and overwhelming. At the same time, it is important to remain grounded. Not every rally becomes a moonshot. There will be pullbacks, corrections, and periods of doubt even within a broader uptrend. Understanding silver's role in a portfolio is about balance, not blind optimism. It is about recognizing that in a world of increasing complexity and leverage, simple, tangible assets have a role that spreadsheets alone cannot fully capture. So when you hear an alert like this, it is not a call to abandon reason or chase excitement. It is an invitation to reassess assumptions, to ask whether the current price truly reflects the risks and realities of the world we are living in, to consider whether assets that have protected value for thousands of years might still have relevance in a system that feels increasingly stretched. Silver does not need perfection to rise. It only needs conditions to move from slightly favorable to undeniably tense. Debt does not need to explode overnight. Inflation does not need to spiral uncontrollably. Confidence only needs to slip, just enough for people to seek alternatives. When that happens, the narrow bridge we talked about earlier becomes crowded very quickly. In the end, silver's story is not about predicting the future with absolute certainty. It is about understanding patterns, incentives, and constraints. It is about recognizing that when many independent pressures align, outcomes tend to cluster rather than disperse. Silver has spent a long time absorbing pressure from monetary policy, industrial demand, supply limitations, and investor psychology. The longer that absorption lasts, the more meaningful the eventual release tends to be. If you already own silver or gold, this is your reminder to understand why you own it, not just how much. If you are considering it, this is your prompt to study its behavior beyond headlines and short-term charts. Markets reward those who respect complexity without being paralyzed by it. Silver, more than most assets, demands that respect. Silver's current setup is not about hype or fear, but about structure, history, and probability. A historically high gold-to-silver ratio, constrained supply, rising industrial demand, stressed currencies, and a heavily leveraged paper market are all converging at the same time. These conditions have preceded powerful silver moves in the past, often catching the majority off guard. While timing is never perfect and volatility is guaranteed, understanding the forces at play allows you to see silver not as a speculative gamble, but as a strategic asset positioned at the intersection of money and modern industry. When the market finally acknowledges that reality, the move is unlikely to be quiet.